bonds. Once we've determined what the bond price is, we need to sell that bond. So we're going to look at the journal entry to sell the bond, and then the adjusting journal entry to record the interest that accrues on that bond, and then paying the interest semi-annually. In this class, we are only going to be selling bonds on their issue date, so it makes it a little bit simpler when we try to compute things. So we're looking at short exercise 6, so SE6. And in SE6, it says we're going to sell a bond on March 1st. And the terms of the bond are, it's a $200,000, 9.5% 20-year bond that we are able to sell at $106. Now you're saying, well, what's $106? Do I sell it for $106? No, what it means when we sell a bond at $106 is that the cash we're going to receive is going to be 106% of the principal or the face amount of the bond. So 106% of $200,000 is $212,000. So when I sell this bond, the company, I'm going to debit cash because I'm going to get 106% of $200,000. Now, when I pay back the bond, remember the bond payable is only for the face or the principal amount, which is what? $200,000. So is there a difference of $12,000 between what I'm able to sell the bond for and its face or its principal amount? Yes, and that $12,000, because I sold it for more than the face, is called premium on bonds payable. You can also call it unamortized premium on bonds payable, but I'm just excited to write down premium at this point. So premium on bonds payable, unamortized premium on bonds payable is it. Now, 6 months pass, and it just so happens to be year end as well. So at year end, because we accrue interest, we're going to have to recognize our promises to pay interest, even though I'm going to pay it the next day. And so I have to figure out the interest expense. Now, here's how we figure it. The interest expense is always going to be the value of the bond. So it's not the principal, is it? It's the full value of the bond. So it's the bond plus the premium, or $212,000. And I'm going to multiply that by the market interest rate. In other words, what everybody else was selling bonds for when I sold my bond. And the market rate, according to short exercise 6, is 8.9%. So everybody else was selling up things for 8.9%. And since only a half year has passed, or 6/12, I'm going to take that $212,000 times 8.9% times a half a year, or 6/12, and I find the amount of the interest expense is $94.34. So that's how much I'm going to debit interest expense for. Now I'm going to credit interest payable for a different amount, because remember, interest is paid on the face amount of the bond. The face amount of the bond is $200,000. The interest rate I am willing to pay on this particular bond was 9.5%. And a half a year has passed, or 6/12. So principal times interest times time gives me $9,500. So as you can see, I'm debiting for the interest, I'm crediting for the interest payable, and this entry doesn't balance. So what we have is the fabulous plug to bonds premium, and that's going to be for $66. So what's going to happen over the life of this bond is, because I was willing to pay more than the current market rate, or the effective rate, notice that I was able to sell these bonds for more than their face, okay, of $12,000. Now, over the terms of the bond, we're going to get rid of this premium every time I recognize interest. And how I do that is by making this entry and finding the difference, and that's how much I'm amortizing or getting rid of the bond premium. So over the term, this $12,000 is going to get smaller and smaller and smaller until when this bond comes due, all I have to do is pay back the what? Principal of $200,000. Now, sun goes down, sun comes up, brand new day, time to send out the checks to our investors in our bonds. So I'm going to debit interest payable for the $9,500, and I'm going to credit cash for $9,500. And thus, I've sent out my first interest payment.